Hey everyone, welcome back to the channel. Today, we're going to talk about something that might sound small but has huge consequences. It's a $500 mistake. That's it, just $500. But this single mistake is silently derailing the financial futures of millions of people. And chances are, you or someone you know might be making it right now. What is it? It's not having an emergency fund. I know. It doesn't sound as dramatic as a stock market crash, but trust me, its impact can be just as devastating over time. Stick with me for the next few minutes, and I'll break down exactly how this happens, why it's so sneaky, and most importantly, what you can do today to fix it. This isn't just about saving money. It's about buying yourself financial freedom and peace of mind. So, let's paint a picture. The check engine light comes on. You take your car to the mechanic, and boom, it's a $500 repair. Or maybe your pet gets sick, and the vet bill is, you guessed it, around $500. For a huge portion of the population, an unexpected expense of this size is a full-blown crisis. What happens next is where the real damage begins. Without that cash cushion, the most common reaction is to reach for a credit card. You swipe it, problem solved for now, and you tell yourself you'll pay it off next month. But life has a funny way of not cooperating. Next month, something else comes up. The credit card balance doesn't get paid in full. And that's when the high-interest debt cycle starts. Credit card interest is brutal. The average rate is well over 20%, so that $500 car repair isn't just $500 anymore. If you only make minimum payments, you could end up paying hundreds of dollars in interest alone. And it could take you years to clear that debt. While you're fighting this battle, you're not just losing money to interest. You're losing opportunities. The money you're resending to the credit card company every month is money that you're not investing. It's money that isn't going into a retirement account, a down payment fund for a house, or even your kids' college savings. This is what we call opportunity cost, and it's the silent killer of wealth. Think about it this way. Let's say you're 30 years old. That $500, if invested in a simple index fund with an average annual return of 8%, would grow to over $5,400 by the time you're 60. Now imagine this isn't a one-time thing. Every year or two, another small emergency pops up, and you keep putting it on a credit card. You're not just paying interest. You're robbing your future self of tens of thousands of dollars in potential growth. This is how people end up in their 40s and 50s feeling like they've been working hard their whole lives but have nothing to show for it. They've been constantly playing defense, paying off high-interest debt from past emergencies instead of building their offense through investing. And the damage isn't just financial, it's mental and emotional. Living without a safety net is incredibly stressful. Every little thing that goes wrong feels like a catastrophe waiting to happen. That constant anxiety takes a toll on your health, your relationships, and your overall happiness. You're always one small step away from a major financial setback. It makes it impossible to think long-term or to take calculated risks that could improve your life, like starting a side hustle or changing careers. You're trapped in survival mode, just trying to get to the next paycheck. So, what's the solution? It's simple, but it's not always easy. You need to build your starter emergency fund. Another great way is to find a small side hustle. Can you walk dogs, deliver food, do some freelance work online, or sell things you no longer need? The goal isn't to get rich overnight, it's to generate a few hundred extra dollars as quickly as possible to build that initial buffer. Put this money into a separate high-yield savings account. Don't link it to your debit card. You want it to be accessible, but not so easy that you're tempted to spend it on non-emergencies. Label it Emergency Fund. This simple act of naming it reinforces its purpose. Once you have that initial $500 or $1,000 saved, you've broken the cycle. You've created a wall between your life and high-interest debt. The next step, after you've paid off any existing high-interest debt you might have, is to expand that fund. The ultimate goal for most people is to have 3 to 6 months worth of essential living expenses saved. This larger fund protects you from bigger life events, like a job loss or a major medical issue. It gives you the freedom to make choices based on what's best for you, not what you're forced to do because of a financial crisis. Imagine the feeling. A surprise bill comes in the mail. Instead of panic, you feel a sense of calm. You just transfer the money from your emergency fund, handle the problem, and then create a plan to replenish the fund over the next few months. No stress, no debt, no interest payments. That is true financial control. It all starts with avoiding that initial $500 mistake. It starts with prioritizing a small savings cushion over everything else. This single decision can literally change the entire trajectory of your financial life. It's the difference between a future spent drowning in debt and one spent building wealth and living with peace of mind. So, I challenge you today. If you don't have an emergency fund, make a plan to start one. Figure out how you're going to get your first $100, then your first $500. It is the single most powerful first step you can take towards a secure financial future. It's not about deprivation, it's about empowerment. It's about taking control and telling your money where to go, instead of wondering where it went. Don't let a small, preventable mistake silently sabotage your dreams. Thank you so much for watching. If you found this helpful, please hit that like button and subscribe for more content on building real, sustainable wealth. Let me know in the comments below what your biggest challenge is when it comes to saving. I'd love to hear from you. See you in the next video. The question isn't whether you can afford an extra $500 a month. The real question is whether you can afford what that $500 becomes over 20 or 30 years. Because the most dangerous financial mistake isn't the obvious one. It's the one that feels completely harmless. It's the small, justifiable expense that slowly, quietly, drains your future wealth. Once you understand this leak, the natural question becomes, if $500 a month can secretly destroy your financial future, what separates the people who stay stuck from the ones who build lasting strength? It's not intelligence. It's definitely not luck. And most of the time, it's not even income. I've met school teachers who built seven-figure portfolios, and I've met high-earning executives who lived paycheck to paycheck. The difference wasn't how much they earned, it was what they did with the next $500. It's all about allocation. Let's imagine two people. They earn the exact same salary. They live in the same city, pay similar rent. On paper, they look identical. And at the end of each month, after all the essentials are paid for, they each have $500 left over. The first person sees that $500 as spending power. It's a reward for working hard. It's the justification for the daily grind. So, it becomes a slightly nicer car lease. A premium gym membership that, let's be honest, rarely gets used. More dinners out with friends. An upgraded flight for the yearly vacation. Maybe the newest phone, even though the old one works fine. None of these things are outrageous. Nothing is irresponsible on its own. They're just small lifestyle improvements that signal progress and make life a little more comfortable. The second person sees that same $500 completely differently. They see it as a worker. A tiny, diligent employee that can be sent out into the world to earn more money on their behalf. So, before they even think about spending it, they direct it into productive assets. They buy into broad market index funds. They max out their retirement accounts. They invest in real estate or ownership in businesses. They put that money into assets that generate dividends, growth, or cash flow. In year 1, both people feel fine. Their lives are pretty similar. By year 10, however, the difference becomes noticeable. The first person has a slightly nicer car and more stories about expensive dinners. The second person has a portfolio that's starting to feel substantial. By year 20, the difference becomes dramatic. By year 30, it becomes absolutely undeniable. The first person owns things that depreciate: cars, gadgets, memories of fancy meals. The second person owns things that appreciate: stocks, real estate, income-producing assets. The first person's strategy is to upgrade their lifestyle as soon as their income rises. The second person's strategy is to upgrade their assets first and let their lifestyle rise slowly, deliberately, and sustainably, paid for by the returns on those assets. That is the $500 difference. We often assume that wealthy people spend lavishly because they have a lot of money. But in reality, most people who build real, lasting wealth delay their consumption far longer than society considers normal. They understand a fundamental truth. Every dollar spent today has a permanent cost tomorrow. When you direct $500 into a car payment, you are buying transportation, yes, but you're also buying interest payments and guaranteed depreciation. The car's value only goes down. When you direct that same $500 into productive assets, you are buying future income. One of these choices shrinks over time. The other grows. And here's the thing about compounding. It doesn't care about your intentions. It doesn't care if you're a good person or if you work hard. It only responds to one thing: consistency. If you invest $500 a month at an average annual return of 8%, over 30 years you're looking at a portfolio worth over $700,000. If you do it for 40 years, that number explodes to over $1.5 million. The later years do far more work than the early ones because compounding accelerates as the base grows larger. But if that same $500 is consistently spent on lifestyle upgrades, there is nothing compounding for you. You're just financing consumption instead of financing ownership. And ownership is the real dividing line between being broke and being rich. The broke mindset focuses on appearances: what you drive, what you wear, where you eat. The rich mindset focuses on assets: what you own, what's working for you while you sleep. This doesn't mean wealthy individuals don't enjoy life. Of course they do. But it means they delay that enjoyment until their assets are doing the heavy lifting. They let their investments pay for the lifestyle, rather than their labor alone. And here's the uncomfortable truth. Most people do this in the reverse order. They upgrade their lifestyle first and hope their income catches up later. That's a backward strategy. Income is uncertain. Markets fluctuate. Careers change, but disciplined allocation directing that first $500 into ownership creates a foundation of stability that doesn't depend on your mood, your motivation, or the economic cycle. I've always believed that financial success is less about brilliance and more about behavior. It's about repeating simple, boring actions long enough for them to compound into something extraordinary. You don't need to outsmart the market. You don't need to have perfect timing. You just need consistency. And that consistency begins with the first $500. Think of it this way. Every single month, you are casting a vote for your future self. When you spend that extra $500, you vote for a future where your lifestyle is supported entirely by your continued labor. You have to keep showing up. Have you ever heard someone say, "It's only $500 a month"? Maybe you've even said it yourself. It sounds manageable, right? But that's where the real damage happens. That's the start of the 3-year trap. It's so easy to think, "I can handle it. And for 1 month, maybe you can." But the problem is, most $500 decisions aren't 1-month decisions. They're 3-year decisions, 5-year decisions, sometimes even longer. Think about how these commitments start. You walk into a car dealership and the payment sounds reasonable. Just $498 a month. It fits right into your budget. You sign the paperwork, drive away feeling great, and life goes on. But what you really signed was a 60-month obligation that has $30,000 committed before you even thought about what else you could do with that money. The same thing happens with personal loans. Buy now-pay-later plans, financing furniture, or just rolling over credit card balances. The monthly number is small enough to feel harmless, but the time horizon multiplies the damage. 3 years at $500 a month is $18,000. What makes this trap so powerful is that it destroys your flexibility. Once you commit, that $500 is no longer available for investing, for building a business, for seizing an opportunity, or even for protecting yourself during hard times. It's spoken for. It's locked up. And here's the thing, financial freedom is built on flexibility. When your income is mostly pre-committed to long-term payments, you have no options. You can't easily change careers. You can't comfortably handle a layoff. You can't aggressively invest when markets drop and opportunities are everywhere. You're tied to a treadmill because that treadmill has monthly bills attached to it. That's the 3-year trap. It doesn't feel like a trap because nothing dramatic happens all at once. You don't wake up in a crisis. You just wake up obligated, month after month after month. I've always believed that risk isn't just about the stock market going up and down. Real risk is loss of control. When fixed payments consume too much of your income, your personal financial risk skyrockets. Even if your life looks stable from the outside, the more of your paycheck that is locked into these long-term commitments, the less resilient you become. And resilience is everything. Let's say you're earning a good income, you feel comfortable, but you have a car payment, a personal loan, credit card minimums, and maybe a few other recurring payments. Each one seemed small when you took it on, but together, they absorb $500, maybe $800, maybe even more, every single month. Now, imagine an unexpected event, a medical bill, a job change, a recession. Suddenly, those fixed payments don't shrink just because your income does. They stay the same while your flexibility disappears. That's how people who earn good money find themselves completely stressed out. It's not usually low income that creates the pressure. It's high commitments. The danger gets even worse when you realize that during those 3 to 5 years of payments, you're not just losing the $500. You're losing the compounding that $500 could have generated. Time is the key ingredient in building wealth, and every year you delay investing is a year you can never fully recover. Compounding is patient, but it does not rewind. If you delay investing $500 a month for 5 years because it's tied up in payments, you haven't just lost $30,000. You've lost decades of potential growth on that money. That's where the real cost is hiding. And here's something else people rarely consider. Commitments reduce your decision quality. When you feel financially tight, you tend to make short-term decisions. You focus on relief instead of strategy. You look for ways to manage payments instead of ways to build assets. Your mindset shifts from growth to survival. It's subtle, but it's incredibly powerful. The people who build lasting wealth protect their future cash flow fiercely. They hesitate before locking themselves into long-term obligations. They ask a simple question: is this commitment worth the future freedom I'm trading for it? And very often, the answer is no. This doesn't mean you should never finance anything. It just means you should understand the trade-off clearly. When you commit to 3 years of $500 payments, you are choosing predictability over optionality, and optionality is incredibly valuable. It's what allows you to invest aggressively during downturns. It's what allows you to start a business when you see an opportunity. It's what allows you to step away from a job that no longer aligns with your goals. Every fixed obligation narrows that option. Most people don't fall into financial traps because they're reckless. They fall in because they underestimate duration. They see the monthly number and ignore the timeline. They see $500 and ignore the 60 months. Time magnifies everything in finance. It magnifies growth, and it magnifies mistakes. The 3-year trap is powerful because it feels temporary. It's just for a few years, we tell ourselves, but a few years is a huge portion of your prime earning and investing window. If you lose enough of these few years to different payments, a decade can pass without any real asset growth. And the irony is that, once the payment finally ends, many people just replace it with a new one. The cycle restarts. Another 3 years, another 5. That's how decades slip by without accumulating any meaningful ownership. Breaking this cycle requires awareness. It requires pausing before you sign, before you commit, before you normalize another fixed expense. It requires asking whether the short-term satisfaction is worth the long-term restriction. Because financial success isn't just about how much you earn. It's about how much of your future income still has freedom. And every long-term $500 commitment quietly decides how much of that freedom remains. So if small leaks sink the ship, and long-term commitments are the trap, then the natural question becomes very simple: what should you do instead? Thanks for watching. If this idea resonated with you, make sure to subscribe for more content on building real financial freedom. I'll see you in the next one. The answer is not complicated. In fact, it's almost boring. But in finance, boring is usually profitable. You reverse the order. Most people pay everyone else first. The bank gets paid. The credit card company gets paid. The car lender gets paid. The landlord gets paid. The streaming services get paid. And if there's anything left, maybe they save a little. That order guarantees struggle. If you want to change the outcome, you have to change the sequence. You pay yourself first, not emotionally, not occasionally, automatically, before the money has a chance to disappear into small conveniences or impulse upgrades. You direct that first $500 into something that grows: an index fund, a retirement account, a brokerage account, something simple, diversified, and productive. You don't wait to see what's left, you decide in advance. I've always believed that good financial behavior should be automated as much as possible. Discipline is admirable, but systems are more reliable. If every month requires willpower, you will eventually lose to convenience. But if the investment happens the moment your paycheck arrives, there's nothing to debate. The $500 becomes non-negotiable. Now, some people will say they can't afford to do that. And sometimes, that's true. If you're carrying high-interest debt, that may be your first target. If you don't have an emergency fund, that might be step 1. But for many people, the reality is not inability, it's habit. They've simply grown accustomed to spending first and investing later. When you flip that habit, something powerful happens. Instead of wondering whether you'll ever build wealth, you know you're building it every single month. Quietly, consistently, predictably. $500 a month invested at a reasonable long-term return can grow into substantial wealth over decades. But the real power isn't just in the math, it's in the identity shift. You stop seeing yourself as someone trying to get ahead and start seeing yourself as an owner. Owners think differently. When markets decline, owners see assets on sale. When news headlines create fear, owners look at long-term fundamentals. When income rises, owners increase their investment rate before increasing their lifestyle. This shift doesn't happen overnight. It happens month by month as you watch your assets slowly accumulate. And here's something most people underestimate: momentum. Once you automate $500 a month and adjust your lifestyle around what remains, you realize something surprising. You adapt. You don't feel deprived. You simply build your life within a slightly tighter boundary. Humans are remarkably flexible. Then, when you receive a raise or a bonus, you have a choice. You can increase the investment to $700 or $1,000 before upgrading anything else. That's how acceleration happens. The goal is not to deny yourself forever. It's to let assets fund the upgrades rather than your paycheck alone. When your investments begin generating dividends, interest, or growth that meaningfully contributes to your net worth, you start to feel a different kind of security. Not the temporary satisfaction of buying something new, but the deeper confidence that comes from progress. Financial freedom is rarely one dramatic event. It's the gradual realization that your assets are working as hard as you are. Paying yourself first also protects you from lifestyle inflation. When the investment is automatic, your baseline standard of living adjusts to what remains after saving. That creates a built-in guardrail. You enjoy life, but you enjoy it responsibly. It also builds resilience. Over time, as that $500 compounds into tens of thousands and eventually hundreds of thousands, you create a buffer. Emergencies feel less catastrophic. Career changes feel less terrifying. Opportunities feel more accessible. Money does not eliminate uncertainty, but it provides options. And options reduce stress. If you follow this approach long enough, something interesting happens. The income generated by your investments begins to matter. It might start small, a few $100s in dividends annually, but it grows. And eventually, that passive income can cover meaningful expenses. When that day comes, you realize that the same $500 that once felt insignificant has quietly reshaped your entire trajectory. It gave you ownership, it gave you flexibility, it gave you time. That is the real objective. Not flashy wealth, not appearances, not impressing neighbors, but time and flexibility. The ability to decide how you spend your days without being entirely dependent on a paycheck. And it all begins with a simple decision, repeated consistently. Send the first $500 to work before it ever has a chance to disappear. Because the same $500 that was quietly killing your wealth can just as quietly build your freedom. If this message challenged you, don't let it end as motivation. Turn it into action. Tonight, look at your last 30 days of spending and find your $500 leak. Be honest, no excuses, just awareness. Then make one decision before your next paycheck hits. Automate the first $500 into an investment account before you touch a single dollar. Not next year, not when things calm down. Now, because financial freedom isn't built by information. It's built by execution. If you're serious about building wealth the disciplined way, subscribe to this channel and commit to learning one smart money move every week. And in the comments, write this sentence: I pay myself first. That simple shift is where everything changes.